Manish, shall we start? I think people are joining, but now it's
Yes, you
yeah.
can start.
Okay. Yes. So, good evening, ladies and gentlemen, and good morning to the two speakers, ladies from UK. To them, it is good morning. To others, it is good evening. I'm Suhas Paranspe, President of BCAS. Welcome all of the participants to this Wednesday lecture meeting, and I welcome all the faculties, namely CA Vijay Kumarji, joining us from Chennai, Ms. Aida and Ms. Nili Shah joining us from UK. Uh, to begin with, I thank BCAS past president and past chairman of Accounting and Auditing Committee and a permanent mentor of Accounting and Auditing Committee, CA Himanshu Kishnadwala, to connect us with these speakers with this subject. So thank you, Himanshu Bhai. Uh, about the BCAS, BCAS is a voluntary body of 9,000 plus members all over with 40,000 plus social media followers. We impart around 3 lakh plus education man hours annually. BCAS is known for its ethical governance and quality standards. Our vision statement says BCAS is proactive to the change, and we try to follow the same in words and in spirit. COVID-19 substantially changed the dynamics of everything about our practice, about our livelihood and everything. And we accepted the changing needs and made ourselves much more relevant with the digital transformation to the extent possible. We very well realize that BCS can increase the reach and scales at a reasonable cost with the digital. It is only because of digital and artificial intelligence that we can bring today's speakers on BCS platform with ease and comfort. Under the physical scenario or under the physical circumstances, it would not have been definitely so easy, though not impossible. BCS flagship event, the 54th residential refresher course, is planned for the first time on a virtual platform from 7 January to 10 January 2021. About uh, the topic for today deals with primary financial statements, which is a project taken up by IASB to prepare new disclosure and presentation requirements for financial statements. And the aim is to reduce the presentation choices as well as ensure greater comparability. There are several changes suggested therein, like new subtotals, greater disaggregation of information, and so on, which are provided therein, which the speakers will take us through. And I'm sure all of you will find the same very useful. With these brief remarks, I welcome all of you once again, and may I request Chairman Manish Sampath to take it forward from here. Thank you.
Thank you, Suhas. Thank you, President Suhas. A very good evening to you all, and a very warm welcome to this webinar on the Primary Financial Statements project of the IASB. I also welcome our keynote speaker today, CAMP Vijay Kumar, who's joining us from Chennai, and our international speakers, Ms. Aida and Ms. Nili Shah, joining us from UK. Other office bearers, past President Himanshu Bhai, conveners Zubin, Rajesh, Amit, and friends. Friends, we all know that besides other statements in financial reporting, there are four main or primary financial statements: the balance sheet, the income statement, the cash flow statement, and the statement on shareholders' equity. Balance sheet depicts the state of affairs on a particular date. The income statement reflects the financial performance during the period. And similarly, the cash flow statement shows the total cash flow inflows and outflows from operating, investing, and financing activities over a period of time. And the statement of shareholders equity shows the changes or the movement in the interest of the company shareholder over a period of time. We all know that there are various stakeholders and users of financial statements, who some who read, try to interpret and understand, and others who try to read, try to interpret and try to understand the financial statements. In an endeavor to have better communication in the financial reporting, to continuously upgrade and ensure better understanding and readability of financial statements, the IASB has undertaken this project of upgrading and changing the disclosures in the primary financial statements. Currently, we are guided by IAS 1 for the presentation of financial statements, and in India, we refer to the Ind AS 1, and moreover, Schedule 3 of the Companies Act 2013 for the presentation and disclosure requirements of financial statements, beside other statutory disclosures also. There, there was a need for a new standard that will ultimately replace the existing standard once it is approved on the presentation and disclosure of financial statements, focused more on the income statement. As President said, that currently the income statement does not disclose all the information that an owner, an investor, an analyst, and other readers of the financial statements are looking for. We just now cannot, if you want to judge the performance of the management, the operating efficiencies, just now the income statement is unable to show us that. um, Currently the income statement is unable to show us the operating profits, the earnings before depreciation, interest, tax. It has no subtotals, etc. Further, there was a need for uniformity, to bring about uniformity, comparability, and consistency in financial reporting across entities from various industries for a better understanding of these financial statements. The IASB realized this, and the project, which approximately started somewhere in 2016 onwards, had issued an exposure draft of the revised standards in December 2019. This entire project also sets out proposed amendments in other disclosures, corresponding disclosure IFRS standards, like those dealing with joint ventures, cash flows, earnings per shares, etc. The deadline for submitting the comments, public comments of this exposure draft was on 30th of September 2020. Now, without dwelling too much into the details, today we have organized insiders, the drafters, and the people who have been involved in the entire project to share their first-hand experiences and insights. I am pleased to introduce the keynote address speaker today, CAMP Vijay Kumar. Ms. CAMP Vijay Kumar is the council member and is chairman, currently the chairman of the Accounting Standard Board and the vice chairman of the Expert Advisory Committee and the Valuation Standard Boards of India. Presently, he is serving as the CFO of SIFI Technologies, an Indian information and communication technology company which is listed at the NASDAQ. We also have Miss Aida. She is the technical staff at the board and is currently the leader of the financial statements project. Before joining the board's technical team in 2008, Aida worked as a management consultant, helping many companies transform and with restructuring and implementation of IFRS standards. She is an ACCA fellow and has done her MBA from the Warwick Business School. Welcome, Aida. The next speaker we have is Miss Nili Shah. She's the Executive Technical Director at the IASB. Miss Nili leads the technical staff that supports the IASB, and it is responsible for the coordinating and delivery of all technical activities in line with priorities set out by the board. Prior to joining the IFRS Foundation staff, Miss Nili spent several years in a variety of roles in the US Securities and Exchange Commission, more recently as the Deputy Chief Accountant of Division of Corporate Finance. Ms. Shah has also worked with PwC in UK and US. She is a certified CPA and CFA charter holder. With these words, I once again welcome all three of y'all. And now I would hand over the proceedings to CAC MP Vijay Kumar to deliver his keynote address. Thank you.
Thank you, Manish. Greetings to all. Trust you are keeping good health and all your near and dear are safe. Sincere thanks to BCAS President Suhas, Manish, Himanshubai, and the BCA Governing Board for the invite. Thanks to Nili and Aida for accepting invite and addressing us today with a detailed presentation. And I equally look forward to listening to you again. It's a well-structured program and best wishes for the success of this lecture. Let me use this opportunity to express my sincere thanks to the entire accounting fraternity here today. Even though I know it's about 100 members, but they constitute the core of the people who are part of the accounting professionals for their active participation in India transitioning to Ind AS, the IFRS Converge standards. I'm very proud of the way we have transitioned seamlessly. Full credit to the members in practice and in industry, with active support from the Accounting Standards Board of ICAI, then chaired by Sri Zavre, Ind AS Implementation Committee, which was then chaired by our present Vice President, Sri Nihar Jambusaria ji, the staff of these two organizations, and the contribution of the co-opted members and various resource persons, many of whom are here today in this meeting. We had several leaders from the region and former NACAS Chairman Sri Amarjit Chopra ji, past President Nilesh Vikamsi ji, past President Manoj Fadnis ji, and CA Sanjeev Maheshwari ji, Chairman of ASB, in whose tenure Ind AS was notified, and CA Tarun Ghia ji, who was Chair of Ind AS Implementation Committee in the initially of transition, who have all lent significant leadership support. For Nili's consumption, India embraced IFRS 9 1 year ahead of the rest of the world. Let me now come to the topic of the day. I've been a firm believer that accounting is about being accountable and financial reporting is communication. Every communication has to meet the objective of 3 C's: clear, complete, and candid. Just like each of us expect in our personal life, communication to us meet the 3 C's. The communication through financial reporting by the preparers and with the auditors expressing an opinion also has to meet the 3 C's of being clear, complete, and candid. The proposed standard general presentation and disclosures, popularly referred to as primary financial statements, seeks to replace IAS 1 and be more communicative than ever. This exposure draft, when finalized, seeks to replace IAS 1, which was issued in 1975 as disclosure of accounting policies, which eventually took an evolved form of presentation of financial statements in 1997 and which was later revised in 2007. This standard would have served effectively 25 years by the time the new standard, the exposure draft of which we will discuss today, hits the road. And this is a period where there has been a huge amount of changes in world trade, nature of business, capital flows across jurisdictions, etc. It is important that financial reporting should also change and stay relevant, else there's a risk that it will be treated as a template for statutory compliance and investors and lenders will find their own path of engaging with enterprises for their information and decision-making needs. The proposal of management performance measures in this standard is a step in the right direction to stay relevant, apart from having an income statement presentation which reflects the way managements and investors look at operating performance. The proposed standard has 120 paragraphs, followed by Appendix A for definitions, Appendix B for application guidance of 85 paragraphs, with consequential amendments in IAS 7, 8, 33, 34, and IFRS 7, 12. Changes are largely in the context of the statement of financial performance, commonly referred to as P&L, the statement of financial position, namely the balance sheet, and cash flow statement has some limited changes. The exposure draft includes the proposals of IASB to improve how information is communicated in the financial statements with a focus on information about performance of the entity reflected in the statement of the P&L. The proposals in the exposure draft, as Manish mentioned, were developed by the board as part of its PFS project, which is part of the board's work on better communication in financial reporting. This project is a response to the strong demand from stakeholders and in particular users of financial statements to undertake a project on performance reporting. In India, we have the benefit of Schedule 3 in the Companies Act, which in a sense is the equivalent of this standard, which has ensured a fairly high level of communication. The present Schedule 3, while it embraces the requirements of Ind AS 1, namely the equivalent of IAS 1, has more disclosure requirements, and some of the elements of the exposure draft are already part of the current presentation requirements in India. The exposure draft seeks to provide better formatting and structure in the IFRS financial statements, especially the income statement, considering the fact that the IFRS income statement is relatively form-free and it has just revenue and profit or loss and not much about everything which is there in between. In practice, both preparers and investors like to use subtotals to better explain and understand performance. The lack of these has led to use of self-defined subtotals such as adjusted profit, EBITDA, etc., also known as non-GAAP measures. While these non-GAAP measures do explain different aspects of performance of the company, as the management views it, it is important that we have a way of communicating it in a manner which is consistent, comparable, and reliable. A more structured presentation of financial statements is also important as more financial information is now consumed digitally, filed in XBRL, and thereafter through artificial intelligence, etc. Lots of analytics is done, intra-firm, inter-firm comparison, including some predictive analytics for investors or lenders to evaluate, and prescriptive analytics as well for managements to consider. I will now highlight some aspects of the exposure draft, while Nili and Aida will make a detailed presentation on the same. And I'm sure their presentation will be a very high value add than the address we heard from Nili and the IASB colleagues a month back, given that they have the benefit of comment letters which they have received from almost all accounting bodies, regulators, corporations, and accounting firms, and even individual members across the world. One, on subtotals and categories, there are three useful subtotals which have been added in the income statement: operating profit and share of profit or loss of integral associates and joint ventures, profit before financing, and income tax. The term operating, investing, and financing here in the exposure draft are not to be confused with similar terms in the cash flow statement. This exposure draft uses the expression operating category, investing category, and financing category. These terms are quite distinct, as the exposure draft uses the suffix category, whereas IAS 7 uses the suffix activities, and they're quite different. The operating category is similar to IAS 7, rightly identified as a residual category, and we have the expression main business activities used in this exposure draft versus principal activities which are used in IAS 7. They look similar but are quite distinct. The associates and joint ventures have been classified as integral and non-integral, where the profit pickup from integral ones fall outside these three categories and effectively represent a separate category just below the operating category. But given that the next subtotal uses the expression operating profit, it is implicitly close to being an operating one. Those which are non-integral would be included in the investing category. In the cash flow statement, however, Cash flows from both integral and non-integral associates and joint ventures will be presented only in the investing activities section, and the IASB has clarified that it did not attempt to align the classifications across the primary financial statements. There would certainly be challenges in identifying those investments which are integral and non-integral, but there is significant guidance in the standard, and I'm sure after the comment letters, there would be more guidance in the standard and through the basis of conclusion. We are aware that managements present a lot of non-GAAP measures of results to communicate the way they view their businesses. An IFRS defined subtotal of operating profit will have two distinct advantages. One, the investors will have a common denominator of operating profit comparable across companies and industries. And secondly, for the managements presenting an adjusted measure of operating profit, the IFRS subtotals will serve as a base to which the adjusted number can be reconciled, and the adjustments to operating profit will become transparent, leading to better comparability. Second, aggregation and disaggregation of information. Aggregation and disaggregation should be done with reference to similar and dissimilar characteristics. Information that is too aggregated is likely to hinder a user's understanding, while too much of detail is likely to obscure material information. And we have seen many cases where excess detail is given and it tends to obscure the material information. Items with similar characteristics should be aggregated together, while those which are dissimilar should be presented separately. This exposure draft gives: one, the strengthening of provisions relating to classification of expenses by nature and function. It is very important, I reiterate, very important to note that it is not a free choice of presentation as was perceived in IAS 1. I personally always felt even in IAS 1, it wasn't a free choice, but it was perceived so. Further, where expenses are presented by function, information needs to be given in the notes for expenses by nature. The second important element is on unusual income and expenses are to be reported in notes to accounts. And these are items unusual either in terms of size or frequency. Unusual income or expense are those which have limited predictive value because it is reasonable to expect that similar items will not arise for several future reporting periods. During the course of my interaction over the last 3 months, I've seen many have a concern that having moved away from extraordinary items which used to be reported on the face of income statement, it is coming back now. I would like to clarify, it is not the case. The unusual items are different from extraordinary ones. Further, and importantly, these will not be presented in the income statement, or rather the face of the income statement. They will be disclosed in notes to accounts for better understanding. And at a 30,000 feet level, these are meant essentially for enhancing predictive value. The objective is to curb the practice of reporting non-GAAP measures, adjusting for unusual items, which we have all witnessed have been misleading. Just as a matter of information, we had this expression unusual items in IAS 1 between 1975 to 1993. And this term was rechristened as extraordinary items, which had life till 2005, whereafter it was withdrawn. Goodwill is the third element. Goodwill is a material item and is always subject to a lot of debate. It now needs to be shown separately in the balance sheet. Let me come to the last important element, management performance measures. Here again, I would like to share my experience based on interaction with members as we developed our comment letters over the last 3 months. These management performance measures deal with only financial performance measures such as adjusted operating profit, adjusted EBIT, etc. It does not cover non-financial measures such as number of subscribers, etc. It also does not deal with measures which are not subtotals of income and expense, such as free cash flow ratios. They are not management performance measures. The management performance measures is intended to cover those which are currently used for public communication outside the financial statements, those which complement the subtotals in the IFRS financial statements, and communicate management view of an aspect of an entity's financial performance. To increase reliability, as these would be part of financial statements and audited, the exposure draft requires reconciliation, description of why management believes this management performance measure provides more useful information, etc. So we have several other consequential amendments in IAS 7, 12, 33, and 34. This standard will be truly transformational and will, today's context of extensive digitalization, will also enable using technology for better communication with digital reporting, thanks to a more standardized form of performance reporting. Of course, in India, we had a standardized form, but if you take the IAS 1 scenario, you don't have the equivalent. And also for investors or users to get more insights without need to dip deep into huge number of pages of notes to get an understanding of performance. To conclude, would like to share that from ICAI, we had issued the exposure draft, held 2 large outreach events. Thankful to all, each of you for having participated in those. 2 study group meetings, a mega joint outreach program with IASB, 4 large Indian companies participating in field testing, and followed up with exhaustive deliberations at ASB before we submitted a comment letter. Let me conclude by reiterating Indian accounting profession commitment for better financial reporting by embracing the 3 C's of communication: clear, complete, and candid. Sincere thanks to each of you for your patient listening. Stay safe, stay accountable.
Thank you, Mr. Vijay Kumar, for your introductory remarks. Now I would request Ms. Nili Shah to start with the introduction and the other related parts of the primary financial statements. Thank you.
Thank you, Subin. And thank you to the BCAS and for Himanshu for inviting us to this event, and Suhas, Manish, and Vijay for your introductory remarks. Vijay, I think we're going to have to borrow your 3 C's of communication. I really liked that. So Aida, we'll find a way to work that in. But I think very, very simply, that's exactly what the board is trying to do. So good afternoon to all of you, and thank you for joining us. For me, it's always an honor to present and very special for me to speak to people in India. And hopefully at some point we can do this in person instead of virtually. But in the meantime, as Vijay said, please be safe. So let me take over the screens here, the slides here, one second. Okay, so today, as the others have mentioned, we will be talking about the board's project on primary financial statements. Now, this project resulted in an exposure draft called General Presentation and Disclosures. So throughout today, you'll hear us use the phrase primary financial statements, PFS, or General Presentation and Disclosures. And when we use that, we mean the same thing. So why don't we first start off with, oops, one second. trying to advance the slide here. Okay, so first we'll start off with the background of this project, give you a little bit of the flavor for the history and the context of how this project arose and the status of where we are right now in the board's deliberations. And then Aida and I will go into some of the main proposals within the exposure draft. We'll go through that in much more detail. And for this part of the conference, we would like it to be interactive. Aida, I hope you don't mind my saying so, but she and I both love to talk, and we can talk for 90 minutes, no problem, but we really would like it to be interactive, and you'll have the opportunity to share your questions using the chat room. And we also have some questions for you so that you can share your comments and opinions as well. And it's really important for us that we hear from you at this stage as the standard is being developed, because this is a point where your views can actually change the board's decision making. Once the standard is finalized, unfortunately, at that point, it's too late and it becomes much more difficult. So we're very, very interested in hearing your comments and what you think works and doesn't work in these proposals. And then after that, we will go into just a few closing remarks, give you a flavor for some of the other projects that the board is working on that we think you might be interested in learning more about. So, apologies again, I'm trying to advance the slides. Okay. So as I said, let's start with the history of this project and where did it even come from? As Vijay had mentioned, the project arose in the 2014-2016 time period. And at that time, the board heard comments from investors that there really needed to be improvement in how and the information that the financial statements were communicating. At the same time, the board was also hearing from preparers that they needed a period of calm. You might remember back at that time, preparers had to deal with IFRS 9 on financial instruments, IFRS 15 on revenue, and IFRS 16 on leases. And these were very significant standards that affect recognition and measurement throughout the financial statements. So very pervasive implications that can take some time to implement. And so as a result of these comments, the board developed what you see on this slide, the Better Communication in Financial Reporting theme. And the idea here, as the name would suggest, is to improve communication in financial reporting. The focus being on presentation and disclosure in light of the view that given all of the other standards from the past that are very, very challenging to implement with respect to the recognition and measurement, a focus on presentation and disclosure might provide preparers with that period of calm while also improving the disclosures for investors. Now, to put this in context, you'll notice on this slide, we will be talking about the primary financial statements project, but that is really just one piece of this whole Better Communications in Financial Reporting initiative. And this initiative has two categories to it. The first is content, and the second is delivery. As part of content, we have, as I said, the PFS project, and then we also have the Disclosure Initiative suite of projects. Those projects are all focused on improving the notes to the financial statements. So as others had said, primary financial statements is looking at P&L, balance sheet, statement of cash flows. Disclosure Initiative is looking at the notes, trying to improve the relevance of the information that's provided, looking at ways to limit the irrelevant information that's provided, and just improve communication overall. And then finally, for content, the board has a project on management commentary, looking at improving disclosures that are outside the financial statements. And then underlying or underpinning all of that is the delivery of this financial information. And as Vijay had talked about, the board focuses on the digital consumption of financial reporting through its work on the IFRS taxonomy. So the takeaway here is the primary financial statements project it's a very significant project. It is, as Vijay said, it's really a game changer, but it's actually just one part of a much larger suite of projects that the board is working on. So specifically to the PFS project, where are we today? As others had said, the exposure draft was issued in December of 2019, and the comment period for that exposure draft just ended in September. And we were very fortunate. We received 215 comment letters, including 5 from India. Very pleased to have that. And during that time, the team and the board members also spent quite a bit of time doing outreach, going to presentations, having one-on-one meetings, having conferences with thousands of people around the world. And certainly the digital or the virtual world helped with that, although I think we're both ready to start meeting people in person as well. In addition to that, during this time, the team has reached out to 50 companies to participate in field work. And what we do with this field work is to ask companies to test the proposals in the exposure draft to get a sense of what's operational and what's challenging, where does the drafting or the words make sense, maybe where it doesn't make as much sense and where people need additional help. And again, we were very fortunate to have a number of companies from India participate in this process. So thank you for doing that. Now, the next step will be for the staff to analyze all of the feedback that it has received and start presenting that to the board, which will begin in December. The board will then redeliberate all of its proposals based on the feedback that it's heard, as well as evidence from academic research and other sources. And then finally, if this exposure draft is finalized, the outcome will be a new standard that will replace IS1. So IS1 will be withdrawn, and then there will be other amendments to some of the other standards that are also affected as consequential amendments. So IS7, IFRS 12, IS33, and IS34. So that is the history of the project. This slide here summarizes what Vijay and Manish had very well succinctly provided as the highlights of the main proposals within the exposure draft. The key pieces, as Vijay had mentioned, relate to the income statement, as well as having some other smaller proposals related to the statement of cash flows and the balance sheet. So again, just to refresh your memories, the key pieces are subtotals, disaggregation, and management performance measures. And Aida and I will go through each of those in much more detail. But the main goal behind all of this is improving the current situation where we have a lack of comparability and a lack of transparency. And then finally, hopefully today's session will give you a chance to ask your questions and hopefully answer most of the questions that you have. But if you are looking for additional information, we have a number of resources on our website, as you can see from this slide. And we encourage you not only to take a look at those resources, but certainly if you have any questions, we're always available to speak to you as well. And with that, Aida, if I can turn things over to you to start talking about subtotals.
Thank you very much, Nili, and good evening, everyone. I'm also trying to find my various buttons here on the screen to take over the control. I don't think I'm quite there. I'm not as efficient as Nili, you see, but I think I'm getting there. So, so as you heard an introduction, what we will do now is walk you through each of the key sets of the proposals, starting with proposals relating to subtotals in the statement of profit or loss. And I heard Vijay making some promises that we will give much more detailed insight in the feedback we have received in the comment letters. And I will certainly attempt to give a flavor of the feedback, but I just want to give a caveat that we have 215 comment letters. Some of them only arrived last week. And, you know, the whole team is working very hard on analyzing them and preparing summary, which we expect to present to the board in December. So today I'm just giving you snippets of flavor from my takeaways, but it might as well be the overall message might get slightly adjusted once we have had a few more weeks to digest all of the letters. So subtotals in the statement of profit or loss, I'm not going to repeat the reasons. I mean, you have heard Vijay already say IAS 1 today only requires revenue at the top, profit or loss at the bottom. And whilst we have some minimum line items, the structure of the actual statement is very much left to companies, or in some cases left to jurisdictions. Like in India, you have a template that you use, which means that on a global scale, when you look at IFRS companies, there's a huge diversity in practice. And what I'm sharing here is in the slide some examples of that diversity we have found. So in our research for the board, we looked at 100 companies across the world to see what structure they use in the financial statements, what subtotals they present. And we found that from these 163 used operating profit, they presented operating profit on face. So that was one, not one, it was the most frequently used subtotal. And then what we did is try to figure out, is this presented consistently, what are the differences, and so on. And in this sample, a small sample of 63, we found at least 9 different definitions of operating. And I say at least 9 because in some cases we just couldn't figure out if some items were included or excluded. The information was just not there in the financial statement, so it might as well be more than 9. And on the slide here, you can see some examples of items that are typically presented differently amongst companies and that are pet peeves of investors. A very common example investors give us is interest on defined benefits liabilities, where some companies include as a part of operating, others treat it as financing. And I will come on to it later. There isn't consensus view necessarily about this, but investors complain about having to spend time to just figure out where a particular company has presented it before they can do anything about it. Another point is a presentation of share of profit or loss from associate and joint ventures, which again is in all sorts of places. In some companies right at the top, at some companies right at the bottom of the statement. Again, just making investors spend time before they can arrive at a common point for analysis and comparison between these companies. So I will talk a little bit about what the board is doing to address that. And we find that the best way to explain this proposal is using illustrative example. So I'm showing a slide with an example, but the example always has some dangers. So I have to give you caveats before I start. First, this is example of what we call general models. So example of a general corporate that would apply the proposals. When it comes to banks and insurers, they will apply it a little bit differently. I will come on to that in a moment. Secondly, the example shows list of possible presentation, and the line items that you see here would not all be required to be presented. It's just an illustrative example. And specifically, this is example of company that presents analysis of expenses using by nature method. As Vijay already highlighted, the nature method is not the only method that companies can use. So if they use other method, this wouldn't be the presentation they would have. But what is important in this example is that subtotals that you see here in a beige color, they would be mandatory for all companies. And what the proposal is for entities to classify the income and expenses that is recognized in profit or loss into 4 categories, which are the boxes you can see on the right hand side. And before I go into the categories, I'm just going to give 2 more caveats. One is that we say the classification applies to statement of profit or loss. So that clearly excludes items such as OCI, but it also excludes a couple of items in the profit or loss, which is discontinued operations. So they are not affected. So IFRS 5 currently requires single line item for that, and that remains the case. So this is not affected by the proposal. And similarly, income taxes. So income taxes is a required line item. It remains to be. So there is no disaggregation required of those items on the face as a result of the proposal. So the proposals effectively start above profit before tax line that you can see on the slide here. So let's look at the categories and the proposals, and I will start with operating. And I like to call operating the star of the show of this project, and it really is most commonly presented subtotal. It's a subtotal that investors tell us they use also most often. And it's quite interesting when we speak to investors or when we have spoken to investors in our 9-month outreach period, they have often reacted with surprise when I say this ED is defining operating profit. I say, what do you mean defining operating profit? Is this not already defined? Like, everybody uses it. There's lots of, you'd be surprised, there were quite a few investors that made this comment because they see it everywhere, so they just assume there must be some rules around it, but there aren't. So it just goes to show how helpful this would be or will be, I hope, for investors in the future. So how has the board approached the operating categories? So clear, the board had clear objective with the operating, and this is to include all income and expenses from companies' main business activities. But this is not all this category includes. And the operating category is defined as a default category, which means the board had said we specifically identify income and expenses that go into these other categories that you can see below, and then any income and expense that does not meet definition of these other categories is by default operating. And the board thought there are several advantages to this approach, and the main one is really there is such a diversity in what entities operating activities are, is that attempting to define it directly would be a very difficult task and would clearly is expected to lead in lots of diversity in inconsistency in application. So this is meant to achieve more consistency in what gets captured in the operating. And also a big reason is that in order for things to add up, you need to have some kind of residual, some kind of default. And it made sense for operating to be this default because by default, what companies do, what are they in business of doing, is their main business activities, is their operating activities. So if you want to pick a default category, it made sense for operating to be this default category. And it's interesting because we thought this may be somewhat controversial proposal, and clearly in some comment letters we had feedback that this is not what some stakeholders desire, but general, I would say it has been quite well accepted that this is quite a pragmatic way and a way that would achieve a better consistency in application and the definition of the operating. So this is operating. Let's look at the financing now at the bottom, financing category that is preceded by profit before financing and income tax as subtotal. So this is kind of self-explanatory. The objective here is to enable investors to compare performance regardless of how companies finance, whether debt, equity, and what kind of mix there is. So what is in this category? You would expect to find things like interest on liabilities, interest on debt, and this is included in line item that you see on the slide described as expenses from financing activities. But this category also includes a couple of other things. One is, you can see here description, unwinding of discount on pension liabilities and provisions. So this is effectively time value of money of this unwind from pensions and provisions, which the board in its discussion on the exposure draft has concluded do not meet definition of income and expenses from financing. So it's not included together with interest on debt, which is in the above line. But the board concluded that it's best to classify it in the financing category because I mentioned earlier there is no consensus amongst users as to whether to treat it as financing or not. But overall, more users tell us they treat it as financing than not. And most users have told us that even if they don't treat it as financing, they prefer a single location because it's easy for them to know where everybody has classified it, and then they can just make adjustments. So there has been, I would say, support for that, but perhaps more support on the pension side than on the provision side. I think I've noticed a few comment letters talking about unwinding of discount on provisions, especially when you're talking about, for example, huge extractive industries companies. And for them, this is clearly a part of their business, providing for decommissioning, long-term environmental obligations. And they are not sure about the classification, whether financing is appropriate for that. But overall, investors have been supportive. And I would just mention one more thing that is in this category that is not presented on slide. We assumed it's immaterial, and I think it probably will be immaterial for many companies, and this is what field work have shown us as well. But if it is material, it will be presented separately, and this is interest on cash and cash equivalents. And the reason this is in financing category is the board thought this is a good proxy of excess cash and cash equivalents that companies would use to offset their financial liabilities, as investors would offset themselves in their analysis of financial liabilities and financial returns. So this is not, I would say, perhaps principle-based decision. The principle-based approach would say you shall split your cash and cash equivalents between those that are excess and those that are used for working capital purposes. But in the discussion, the board concluded that making this split would really force companies to incur costs that would far exceed the benefits of the split. So as a almost practical expedient, the board has said, let's treat all of cash and cash equivalents as a proxy of the excess cash. And we know there are cases of companies, Apple is one example, that this is maybe not the best outcome. As it happens, they don't apply the IFRS as of yet anyway, but it is recognized that this is not perhaps perfect, but it's a pragmatic way to deal with the issue. So this is financing category. Now, investing category there in the middle, just above, the whole idea behind investing category is, as Vijay has mentioned in introductions, it's not the investing in the sense of statement of cash flows versus investing in your future, but it is about, these almost excess investments or additional investments that company does that are not clearly part of their operating activities, and they are defined as investments on assets where returns arise individually and largely independently of other resources of entities. And you probably recognize this. We have borrowed this from definition of investment properties in IAS 40. And the idea here is to capture things like returns on financial instruments. So everything other than cash and cash equivalents will be captured here. Also investment property returns and fair value remeasurements would be captured here, again, all with proviso that this is not part of your main business activity. If this is your main business, it goes into operating, and I will come on to that a little bit later. So this is investing category. And then we are left with integral associate and JVs, which is squeezed there between operating and investing. And I'm just going to show a separate slide that gives a little bit of background explaining how that came about. So with these three categories, the board was left with making a decision, what do we do with share of profit or loss from investments in associate and JVs that are accounted for using equity method. So as you know, equity method accounting means you only have one line item, share of profit or loss, and you might have also associated impairment of those investments presented on in some financial reporting periods. And we sought feedback from investors. We discussed this with preparers before the board published the exposure draft, and we had a range of views. From investors, we had a very strong message that they do not, whatever the board does, they don't want to see this as a part of operating, because they say these investments are not controlled in the same way that operating activities are. They are after tax, they are after finance costs. Again, it would mess up our margin analysis of items in the operating because they are not comparable on like-for-like basis. We want to analyze them. It's important information, but we want to analyze it separately from operating. So this was investor view. On the company side, however, they said, look, we understand what investors are saying, but for us, many of these are closely related to our main business activities. And today, we know many companies present them as a part of operating, and we want to continue either presenting as a part of operating or as close to operating as we can. So the proposal in the exposure draft is to require companies to make a split between these closely related associate and JVs that would be classified as integral and will be presented straight after operating, and those that are just like any other income and expenses from investments, so their returns arise individually and independently from other resources, and they are called non-integral, and they would be in the investing category. So I'm just going to show you, go back to this slide showing the presentation. So I've assumed in this example that both are material, but you might not have that in all circumstances. So the integral associate and JVs, as I said, presented straight after operating, and then there's a subtotal that adds up operating and integral associate and JVs, and then non-integral are in the investing category. This has been one of the most controversial proposals in the project, I would like to say. And we had a mixed of views, and I think this is one where I may be at the danger of highlighting the wrong thing, because just yesterday I was going with a colleague who is working on the analysis on the spreadsheet on this, and there is like 20 different arguments, and same arguments are made by those who support and don't support this. It's going to take us a little bit more time to just figure this out. But the highlights of this is investors don't feel that this is important in most cases. So lots of feedback of them is, I don't care, why, it can be misleading. Companies will just use opportunism to classify things that are profitable in integral, non-profitable, non-integral. They're very skeptical. And then they say, why do you give it so much prominence anyway? Can't you better put it in the notes? I say most investors, a few investors have been supportive. They say now industries that we follow is important, and actually I can see it will be interesting information to see. On the company side, you would think, oh, well, this meets your needs to communicate those that are integral. But actually, many companies say, look, even we agree with this in principle, but your definition just doesn't give us the outcome we expect to have. And the things, and I think we had the cases of this in India as well, discussing with some of the stakeholders, things that they see as integral don't actually meet the definition, because we think of things that, independence of returns is important, and often by definition the returns are independent even if the activities are considered integral. So there's been lots and lots of issues raised. So I think this will be one of the things that the board will have to discuss in lots of detail, going back to the basics in terms of whether this is proposal where benefits exceed the costs, and then how to fix it, because I'm pretty sure the proposal as proposed in the ED can't remain without adjustments. So this is integral. So I can see that we had a couple of questions, and we also have a couple of questions for you. But before I move on to that, I'm just going to spend a minute or two just to give a highlight of how these proposals work for the banks and financial institutions. So it became quite clear early on that whilst this general model works for corporates, it wouldn't work for a bank, because what we would mean for bank is that their finance expenses would be presented below operating profits. So the banks couldn't present, for example, net interest income, which is their key performance metric, and that wouldn't be useful. That would be less than useful. It would take away from usefulness of their statement of profit or loss. So it was clear that we needed to think a little bit about how to ensure this objective of operating, capturing main business activities and income and expenses from those is achieved in these circumstances. So this slide illustrates that, and what the board has done is proposed principles that are based on main business activities, which dictate when companies are required to move income and expenses from investing or financing into operating. So if I go from the left, from the financing, this principle is when you provide finance to customers as a main business activity, you have to move either related finance costs or all of the finance costs into the operating. And the reason this is a choice of moving related or all is because these proposals have to fit with multiple types of companies. You have conglomerates, you have a business, you have banks that are also insurers, that are also do other things. And sometimes for them, it's just not practical to split finance costs between those that relate to their lending activities and to other activities, but in other cases they can. This is another proposal, so I would say, has attracted some controversy about giving free choice. So I think we would need to probably revisit, discuss that, whether that can be tightened. And then on the investing side is quite simple. Any investments income that relates to your main business activity, either because it's investment made in the course of main business activity or as a main business activity per se, goes into the operating. And this is meant to capture companies like property companies, insurers, any other investment companies. And here we just have a small example of what this could look like for investment and retail bank. You can see in green, interest expense is not in financing, it's moved up. You can see in gray items that would otherwise be in the investing category, they are in the operating category here. In this example, we do not show profit before financing and income tax because the ED says if all of your finance expenses are moved into the operating, then clearly such a subtotal is misleading, not necessary, and it shall not be presented. So this is my whistle stop. As Nili has warned you, I can talk. I love this topic, and there's lots of nuances here, but I think it's a good time for me to have a pause. And what I will do now is attempt and maybe ask one of the colleagues, panelists, to maybe share the first poll, or shall I attempt to do it myself?
Yes, I think there are a couple of questions which I can see. I think other income should be bifurcated between operating and non-operating income. Oh, sorry, you are going through the polls first?
Yeah, I will just let the poll up for our participants to answer the questions, and I can whilst doing that, I can answer the questions. So as you said, the first question is about other income and operating and non-operating, and non-operating other income should be shown below dividend income. And I can see that this view is held by some companies who have in their comment letters said, well, we don't want things like gains from disposals of PP&E, for example, to be presented in the operating because we don't see them really as a part of our, key performance metrics that investors use. And proposals clearly allow for this to be presented as a separate line item in the operating profit, but it is captured in the operating category because the board's thinking of the operating is it arises as a result of your operating activity. So the reason you have PP&E is, because it supports your operations, and therefore any gain and disposal from that is also related to your operations, even though you might not analyze it and present it in the same way as you do with revenue and cost of sales. So that is the proposal, and that's the reason for the proposals. But I understand there is a view of some that some of these should maybe bifurcated, and maybe we need to look at that within the segregation proposals, how we can enable companies to do that.
The next question is, where is finance income shown? But this is again presumably partly, I think, it's part of the first question. I think the question is coming because you have shown in the format that the finance expenses are only shown as part of the expense, under the financing portion. So maybe we should show finance expense or finance income on a net basis. I think that is what is probably coming.
Yeah, so we have, and I know some companies today net this, and this netting will not be possible because when we talked about finance category, we said a finance category only has income from cash and cash equivalents, part of income, and then the finance costs. And the other finance income in a general corporate situation is included in the investing category. So things like dividends, things like return on financial instruments would generally not, so they wouldn't be in the operating by default. What would be in the operating is perhaps your non-core activities income, but not from these investments that are quite independent, which financial investments generally are. So that income would be in the investing. I have to say with proviso, if you are investment company or if you are a bank, then in those cases it ends up in the operating.
I presume this is more for general corporates, I think, the query, presumably. There is one more question. Some listed companies create a PE type investment company. Would this be classified as integral or non-integral?
So the proposals for integral and non-integral only apply to investments accounted for using the equity method. And only associate and JVs accounted for using equity method. And if your investment meets this criteria, then you would have to classify it as either integral or non-integral. But there are also a number of investments that can be associate and JVs that could be measured using other measurement bases. And I think investment companies often measure their associate and JVs using fair value. And if they do that, and if this is your main business activity, for example, then you're actually likely to end up with this in the operating. If it is not your main business activity, then it's just another income and expense from investments. So this integral, non-integral doesn't come even into play. It's only relevant for equity method investments. I don't know if this answers the question, or is there?
I think what you are saying is right. I think basically integral, non-integral, the way it is intended, maybe more for joint ventures and associates. So I think to that extent, it would be by default and operating under the operating category. I just have one fundamental question for you. I mean, it may be a little odd. I think, is there any specific reason why we are using the term primary financial statements, I think? I mean, any particular reason? So what would be secondary financial statements, if I may put it the other way?
I think it was, I love these questions. It kind of makes me think, oh my God, I don't remember specifically, but just thinking about it now, I think often when you say financial statements, financial statements as a term is all encompassing. So when you say financial statements, that is taken to mean both what we call face and the notes. But then using term face is quite ugly slang, isn't it? And it doesn't seem something very fitting for, standards, even though in our day-to-day speak, I still am guilty myself. I sometimes, do you put it in on the face or in the notes? But then primary just came about as a way to distinguish, to give a label basically for the face, as opposed to the notes, because financial statements alone includes everything. But I don't know, do you have other suggestions? I'm quite happy to hear.
No, I mean, because I mean, these are presumably because sometimes, I don't know, in the Indian context, there are separate statements or memorandum statements or management statements which may separately have to be presented to the bankers, or certain financial information which may have to be separately submitted to other categories of users who are probably not the primary users. So is it something to do with that?
Yeah, it's not really to do with primary users or not, because the whole financial reporting is for the same set of users.
We normally use the term general purpose financial statements. That is how we have understood. So whether it is the same.
Yes. So this is all in the general purpose financial statements. It's just a term to distinguish between what's on the face and what is in the notes. Yeah.
Ultimately, what is in the notes also, is it in a way not a part of primary financial statements, because notes are also considered as part of the financial statements. At least that is the way our schedule 3 here, which we are referring to.
Exactly. Yes.
Anyway.
And it's misleading. I am like, as Nili mentioned, introduction, we use all these different labels in the project because, and we had so much fun discussion when we were discussing the name of the exposure draft, because calling the exposure draft primary financial statements was wrong, because as we will come on to, we have quite a few proposals relating to notes. So that's why we said, even though our project is called Primary Financial Statements Project, to label the standard or the ED in that way would be misleading, because lots of proposals relate to information included in the notes. So we ended up with general presentation and disclosure. Yeah.
I think there is another general remark, I think, on the classification between integral and non-integral, which will pose challenges. I think you've already addressed that already, that you are also looking at it. I'm sure that is going to be one of the critical things. I think we may not have heard the last of it, as you have said.
Yes, that's quite fair point, I would say.
So I think that maybe it takes care of the questions, I think, up to this point of time. Maybe we could proceed further on disaggregation.
Okay. I've just ended the polling, so I'm just gonna share results with everyone, because this is always quite interesting to see. And we can see again, operating profit is also the star of the show today, where most participants said the operating profit would be useful, but perhaps not as much for the other subtotals. And it's quite interesting for me to see that the profit before financing in particular only received 20% of the votes. You know, we do get feedback that would also be useful, but absolutely consistent feedback that operating profit is the most useful subtotal. So, and distinction between integral and non-integral, it's interesting that many of you think it is useful. And I would like to say, yes, if we get it right, I can see how that could be useful, but it seems to be that, as you just remarked, we are not quite there, and the question is, you know, can we get there in this project? So that remains to be seen. So I will stop this now, and I will go back to the presentation and move on to proposals relating to disaggregation. Okay, so we have done that. So disaggregation is a range of proposals in the project, and this is the bit where we go beyond primary financial statements, which we discussed just now. And it's really in response to feedback from investors that often they don't get information they need. Information can be sometimes too aggregated to provide relevant information, or sometimes it can just be too much information, provided that you actually struggle to find what is important and relevant and material information. So we have proposals here which are really aiming to strengthen the requirements for disaggregation. So nothing here is really completely new, revolutionary proposal, although despite that, as you will hear, some of them are still quite controversial. So we have some general proposals around principles, and we also have some specific proposals relating to analysis of expenses, unusual income and expenses. So I will just briefly cover all of them. So starting with the general proposals, we have proposals for the rules of primary financial statements and the notes, and just to help companies again decide what we just discussed was what information to include on the face, to use that term, what information to include in the notes. We have some small proposals around the minimum line items. So as you know, IAS 1 today requires a number of minimum line items, and the board has not done comprehensive review of those. And in this project, it is something that is done in individual standards as they are being developed. But nevertheless, as a part of this project, we are proposing some separate line items arising from proposals on integral, non-integral, associate, and JVs that would affect all financial statements, not just P&L, and also a separate line item on goodwill, because the board thought that it has sufficiently different characteristics from intangible assets to warrant separate presentation. But then I'll move on to the next set of general proposals again for disaggregation, and this one is quite important in my view, which is the principles of aggregation and disaggregation. And this is really a set of principles for companies to follow to help them identify what is material information. And it is based on shared characteristics of items. And when I say items, it's income and expenses, but it's also assets and liabilities and cash flow. So this is applying across the financial statements. And it's really to help companies think, is there anything in these items that has different characteristics that would require me to disaggregate them? And often we find examples where companies say, oh, you know, these financial instruments are measured at fair value through profit or loss, and this is all the information I provide. I have a line item financial instruments at fair value to profit or loss. But when you think about characteristics, you ask yourself, well, are these instruments subject to different risks because they are in different sectors, they are different types of assets, they are in different regions, and then are these differences in risk sufficient that they disaggregating this provides material information to investors? So that's the kind of thinking we want to encourage companies to have, and not just stop with what is required disclosure. So that is really the idea behind the principles of aggregation and disaggregation. And then related to that, we have tried to tackle what we call the problem of other. And, you know, I'm sure you've seen this in practice, in that many companies would sometimes have big numbers described as other with no further information. And when we speak to them, they often say, oh, well, this is all individually material, and this is all being cleared with the auditors, and there's no problem there. And we are not saying that we dispute that in any way, but what we hear from investors is they often worry when they see things like this, because they don't have any assurance that, is there anything in this other that I need to worry about as an investor, that I need to take into account in my analysis? So with that, we have proposed some guidance regarding that. First, encourage company to look at this other again and see, is there anything there that is material that needs to be separately identified? And can I avoid label other? Is there more descriptive label? And sometimes there isn't. So if I have to use label other, then at least I can provide some reassurance to investors. This is the type of things in there. This is the single biggest item, just so that they don't have to worry, is there anything here I need to do for my analysis? And, you know, this has been quite popular with investors. All the companies in the fieldwork have told us that for them, it's maybe they struggle with practicality. So we will need to take a look at that. So these are general proposals, and now two specific proposals, and perhaps most controversial parts of these proposals. One is relating to analysis of expenses by nature and by function. And, you know, Vijay, you mentioned earlier, you know, this is really strengthening existing requirements, and many have same view that you hold, that is that IAS 1 already requires entities to present expenses either by nature or by function, but we know in practice that many companies provide a mix. So just as a reminder for everyone, by nature analysis of expenses is when you provide information by inputs used, so staff, depreciation, and so on. Information by function is when you allocate those inputs to functions within business, for example, cost of sales, research and development, selling costs, etc. So either both methods are valid, and the board is saying companies shall select the method that's most useful to them. It's not a free choice. And ED provides some indicators to help them decide what's the most useful method. And then once company has selected method, it shall not mix the methods. So that company, if presents cost of sales, it will have to allocate, for example, depreciation between cost of sales and other functions, and not just choose to have it non-allocated hanging separately. When I say mix is not allowed, there is an exception, because we talked about minimum line items before. And when you have a minimum line item, then you shall always present it if material. And therefore, even if you're presenting, for example, by function, you're still required to present credit impairment losses if those are material, because this is minimum line item. And then finally, there is also a requirement, proposed requirement for companies that present analysis of expenses by function on face, to provide analysis of expenses by nature in the note. And this is as a result of users giving feedback that this information is useful for forecasting, regardless of what is the primary method that company uses on face. because by function analysis is useful for them for margin analysis, but when they look to forecast future cash flow, they say they can always do a better job when they have information about nature of inputs. So this is the proposal, but you can imagine that companies that currently don't have systems set up to provide analysis by nature tell us that this is quite complicated for them and quite costly exercise. And we had lots of feedback on that, including as a part of the field work. So this is something I think we will have to review going forward as to whether complete analysis by nature should be required and whether the costs of that are justified by the benefits to investors. So that is the penultimate point. I'm just going to talk now on the final points on the disaggregation suite of proposals. Another specific proposal relating to proposed requirement to disclose unusual income and expenses. And, you know, this is again nothing new. I think Vijay again in introductory remarks mentioned the history of these requirements and the different terms we had. But the fact of the matter is that many companies today disclose items that they label non-recurring, and it is often not clear how these items have been identified as non-recurring and whether this is complete identification or whether the company has been selective in labeling non-recurring. So investors have expressed concern about this because in principle they're interested in this information. It helps them in forecasting, but they don't have any assurances that it is complete, that, you know, sometimes we find only expenses are identified and revenue is only identified as non-recurring in next year when that revenue fails to repeat. And investors say, we want this information, but we want it in more disciplined and we want it in more complete manner. So this proposal is here to address that, to focusing on limited predictive value, so income and expenses with limited predictive value, and would require companies to identify those income and expenses. This is very much forward-looking definition, so it looks at your expectation of what will happen in the future. I'm just going to show you this as an example because I think this is important, because often when people think of unusual, you think of something that hasn't happened before. And I think that's kind of normal way of understanding this unusual in everyday speak. But the definition of unusual income and expenses relies on it's unusual because I don't expect it to recur. So in our first example, this could be, for example, impairments. You know, I had impairment a few years ago, and I'm having it this year, but I don't expect I will have impairment in future periods, and therefore I classify it as unusual. In second example, it could, for example, relate to restructuring. I don't restructure regularly in this case. Some companies do, but in this example, let's say not. But this restructuring program is going to last for a couple of years. And therefore, even though I have expense this year that I didn't have in past, because I will have expense in next couple of years as well, it is not classified as unusual. And this is perhaps more controversial part of definition, I would say. And then finally, the last example, this could, for example, relate to litigation costs, your legal costs. Every company has some of those every reporting period, but you could have a period where you have a significant effect of these because, for example, of a single case, and you don't expect this effect to recur in the future. And this is a situation of unusual by amount where you actually do not, even if you have something, because the amount is so different, it's identified as unusual. And just the final points on the unusual. So this is very much disclosure. So it's not something that would be on the face, because we talked about on the face, you do analysis by nature or by function, and unusual often doesn't fit neatly into that. But you are required to attribute your unusual income and expenses to line items on the face, so users can see what items they relate to on the face. So that concludes our tour of disaggregation proposals. So I will do the same. I'm just going to share the polling whilst we look at if there are any questions relating to this topic.
I don't think there are any specific questions.
Okay. So I'm just going to launch maybe quickly a polling questions on this. I can't see anyone answering yet, but I hope we'll get some comments.
I think now it's.
Yeah. It's it has been quite controversial. I mentioned expenses by nature function because of the costs for those that don't already provide information by nature. Unusual has also been subject to lots of controversy in that some want definition to be broader, to capture things like restructuring that I showed on that slide, that, you know, much freer definition. And there's also demand from some to provide unusual income and expenses on face, which currently the proposals in the ED would not allow. So it's an area that needs to be reviewed. So just in the interest of time, I'm just going to spend a few more seconds, you know, to get a few more results, and then I will share the poll before I hand over to Nili to walk us through proposals for management performance measures. Okay.
Yes.
So I'm ending polling and I'm sharing results. And we can see that there is a mixed views on unusual on the mixing nature and function. And, you know, many of you agree with prohibition, but, you know, quite a few of you think there should be additional items as an exception. And I think this is quite fair view that the board needs to consider whether there should be further exceptions to no mixing. And then on unusual, there's lots of support, but, you know, some are concerned about definition. Again, it's quite consistent with the feedback we've been hearing. So with that, I'll stop now and I'll hand to Nili for MPMs.
If I can ask on disaggregation, see, especially yes, mainly in the context of revenue, I think in the new standard, it's mentioned the 115, which has come in, the new revenue recognition standard, it talks about disclosure. The disaggregated information should be in line with the segment disclosures. So how does segment disclosures and segment reporting really fit in with the disaggregation principles and disclosures?
Disaggregation principles and disclosures are really an overlay on top of all the specific requirements in the standard. So in the individual standards, the board has decided in any circumstances, particular items, you know, are relevant and if material should be disclosed separately. And this is the judgment boards makes when they consider specific areas. And this is just an overlay just to help think through, because for your companies, there might be a different cuts and different information because of your specific circumstance that could be material. And that to remind people, just because individual standard doesn't have this as a disclosure requirement, you still need to think about, is there anything there additional that needs to be disclosed to provide material information?
Thank you. Yes. I think we can proceed with the management performance measures. Over to you, Nili.
Okay, thank you. So management performance measures, you might be wondering what that is, because it's a new term that we created as part of this exposure draft. And for right now, think of it as non-GAAP measures. And I'll explain what that is in a minute. But let's start with what is the issue that we're seeing. And as you can see from this slide, we looked at a sample of 100 companies, and almost 90% of them have at least one non-GAAP measure presented in their financial reports. And that in and of itself is not a bad thing. We don't want to try to get rid of management or get rid of non-GAAP measures. The problem, though, that we're seeing is that the disclosures around these measures are not transparent. They can be difficult to find, and sometimes they change from one period to the next. So it could actually be a little bit misleading for investors. So the board came up with a number of disclosure proposals as part of the exposure draft that would do two main things. The first is require management performance measures, which is a subset of non-GAAP measures, in the notes to the financial statements. And then it would also require some disclosures to enhance the transparency and the discipline around those non-GAAP measures. And I think this is really important. If you think back to Aida's session on subtotals, the point about the subtotals is to try to get comparability on the I'll use the word face, on the face of the financial statements or the primary financial statements. But we've also heard from some companies that they were concerned that that comparability and those definitions would be too limiting for them to tell their story. And so the ability to use or to communicate with management performance measures allows companies to also tell their story in the notes to the financial statements and complement what's in the income statement. So moving on to exactly what are management performance measures. And you'll see the three criteria on this slide. The first is that these are subtotals of income and expense that are used in communications outside the financial statements. And one of the reasons that we have that as a criterion is that we're trying to ensure that a company has consistency in their messaging from what they disclose in management discussion and analysis, what they disclose in press releases, as well as what's inside the financial statements in the notes. Secondly, the management performance measures complement the totals or subtotals specified by IFRS standards. So we don't mean to suggest that these measures are more prominent or more important than the IFRS measures. IFRS measures are first and foremost, and these are complementary. And then finally, as I mentioned before, these are measures that communicate management's view of an aspect of an entity's financial performance. So it could be the case that a company presents other measures outside of the financial statements, but they may not present management's view of its performance. In that case, it wouldn't be a management performance measure. So a company might present something because it needs to for regulatory purposes, it might need to for contractual purposes, but that does not necessarily mean that it's a management performance measure. The other thing to bear in mind is that a company may not have any management performance measures. If it's communicating its performance just using those specified totals and subtotals in the income statement and in IFRS standards, then there's nothing else that's required to be disclosed. There are no management performance measures in that situation. A little bit more detail on what management performance measures are. And Vijay did a really nice job explaining this, that there are a number of metrics that are presented, but not all metrics will be management performance measures. And if we start out with the left-hand side of the slide, anything that is non-financial in nature would not be a management performance measure. So this could be number of eyeballs that look at a website. It could be the space in a store. It could be the number of subscribers. Those are all non-financial metrics, not management performance measures, and therefore could not be included or would not be considered for inclusion in the notes. And then of the financial performance measures, Vijay had also mentioned this. What we're looking at are well, let me first start with, we're looking at subtotals and totals of income and expense. So performance measures. You might have other measures related to the balance sheet, related to the statement of cash flows. So free cash flows, net debt, those are not considered management performance measures. And then, of course, as I mentioned previously, IFRS specified measures are not management performance measures. Now, one of the pieces of feedback that we hear with some frequency is, well, why are you just focusing on performance? Why are you not also considering other measures such as free cash flow, return on equity, net debt, other measures, financial measures, but not related to that income statement? And the reason is that what the board was focused on as part of this project is that statement of performance, the profit or loss statement. It could have expanded the scope to consider other measures beyond that income statement. The challenge would have been, though, the more you expand the scope of a project, the longer it takes and the more deliberations that would be required. So it just would slow down the ability for the board to sort of have these quicker wins and quicker improvements to the financial statements. But I think, and Aida, correct me if I'm wrong, but I think that's definitely an area where we've heard quite a bit of feedback and will require some further deliberation from the board. The other thing I'll just mention is that in the exposure draft, the board does not place any specific restrictions on the calculation of the management performance measures. So you might be familiar, there are some countries where regulators just prohibit certain types of non-GAAP measures. The board doesn't specifically do that, but it does have an overarching requirement that these management performance measures need to be a faithful representation, and they need to be understandable to users so that they're not misleading to those users. Okay, so this slide now talks about, now that we know what our management performance measures are, what would be disclosed related to those management performance measures. And the first requirement is a reconciliation of that MPM in the notes to an IFRS specified measure. And this is a requirement that a number of regulators already have. So this piece in and of itself is not significantly different, but part of the requirement is ensuring that we get consistency across the world and ensure that all the countries around the world have similar disclosure requirements for the reconciliation. In addition, the proposals require clear labeling and explanation of how these measures are calculated, a statement that the MPM is not necessarily comparable across all entities. And as you can see on the right-hand side of the slide, it also requires disclosure of the tax and non-controlling interest impacts of the reconciling items. And the reason for that is that we had heard from users that when they're looking at these reconciliations, they may not agree with management's determination of what should or should not be an adjustment. So if they want to take a management performance measure and then further adjust it themselves, so for example, remove one of the adjusting items, they can do that, and then they know the tax and the NCI consequences as well in order to calculate the earnings per share impact. So in summary, these disclosures are intended to do a few things. The first is to have a single location for the management performance measures in the notes to the financial statements. And as I mentioned before, one of the reasons that we're doing this is because investors have observed that it's very difficult sometimes to find where these non-GAAP require or where these non-GAAP disclosures are. So for those countries that have requirements, that's helpful, but it's not helpful enough because they can't find the actual disclosures. Secondly, our view is that by including these disclosures in the notes to the financial statements, they will be subject to audit, which might improve the quality and the transparency associated with those disclosures. Third is that we're looking to provide more disclosures or more transparency around these measures through the additional disclosures, in particular around the tax and the non-controlling interest effects, which from the research that we've done is something new. No other regulator, as far as I'm aware, does something similar to what this proposal does. And then finally, as I mentioned, these requirements or these proposals would allow for consistency across all of the countries that use IFRS standards, because right now, for the most part, non-GAAP measures, the regulation is determined by the securities regulator, and so that'll vary from country to country, and this will provide some of that comparability. One final thing I wanted to touch on is EBITDA, and I saw there was actually a question in the Q&A about what do the subtotals mean, and does that mean that EBITDA is going away? And we'll start off in Aida's presentation, you probably noticed that the board does not define EBITDA. That is not one of the required subtotals that's coming out of this exposure draft. And the reason for that, after much deliberation and much outreach, is that the board could not identify a single underpinning concept of what EBITDA is, what its purpose is, and how it's used. And it's also not consistently used across all industries. So then you might be wondering, well, if EBITDA is not defined through the subtotals that Aida described, does that mean that it is a management performance measure that would then be subject to all of the disclosures that I just spoke about? And the reason, or the answer is maybe. If EBITDA is simply operating profit before depreciation and amortization, in that case, it's not a management performance measure because operating profit is defined, depreciation and amortization is straightforward. So in that case, it's not an MPM. You don't need to worry about all of the disclosures that I just spoke about. However, if there are adjustments beyond that, if it's adjusted operating profit before depreciation and amortization, and then excluding restructuring and impairments, then you start moving into the MPM land and the MPM related disclosures. So then the following thing that you might be wondering is, well, okay, if operating profit before depreciation and amortization is not a management performance measure, then why not just call operating profit before depreciation and amortization EBITDA? That seems logical, and then that would solve the problem. And we did think about that, and the challenge is with the words. So EBITDA means earnings before interest, taxes, depreciation, and amortization. If we say operating profit before depreciation and amortization is EBITDA, that would mean that operating profit is EBIT. So that would mean, logically, operating profit is earnings before interest and taxes. But the problem is operating profit is not all operating or it's not all earnings. As you might recall from when Aida was talking about the different parts of the income statement, we have earnings that are in that investing section that are not included in operating profit. So just the logic of the language of EBIT and EBITDA just doesn't work, and that label would not be faithfully representational as we would have expected from a definition. So the takeaway here is that the board did not define EBITDA. However, if your usage is simply operating profit before depreciation and amortization, it is not an MPM. You do not need to include the disclosures that I just spoke about. And with that, we can move on to our final polling question. Aida, if you can launch that. And Zubain, there's another question here. I think I spoke to the one about EBITDA, but I see a question about sustainability reporting. Shall I go ahead and take that one now while we're waiting for the polling question? Oh, sorry, you're on mute.
Yes, you can go ahead.
Sure. Okay. So we have one question here. It says, since the world over emphasis is on business responsibility and sustainability reporting, how will the exposure draft be influenced by the said reporting? It's a really great question. And actually, it's a separate piece of work that the trustees to the IFRS Foundation are consulting on. At the end of September, the trustees issued a consultation document to get feedback on, first, whether there's a demand for global sustainability reporting standards. And then if there is a demand, is there a role for the IFRS Foundation to play? And then if there is a role that stakeholders think we should play, what does that role look like? And in that consultation document, it talks about the possibility of the foundation creating a separate board that sits alongside the IASB. So this would be, if you think about, here's the IFRS Foundation, and right now we just have the IASB. This would be another board that's still under the foundation, but just a sister to the IASB, that could focus on sustainability reporting standards. And what the trustees are first trying to determine is really, is there demand? That's the main thing. We don't want to presume that the world needs another set of standards, because there already are a number of different organizations that create sustainability standards. And so if there were something to be done, the focus would be on something global, yet still taking into consideration and using the regional initiatives and the other standard setter initiatives. In terms of this particular exposure draft on primary financial statements, and what does that mean for sustainability? I think realistically, it probably doesn't have a lot of intersection at the moment. It's more so the board's project on management commentary that I spoke about earlier, where management commentary is really the home for any sorts of sustainability disclosures that you would normally find by a company. And Aida, has the polling closed? Should I take a look at the results?
Yes.
Okay, so we have, the question is which statement best reflects proposals on management performance measures? And we have about 50% that believe that the introduction would provide useful information. But there is some observations here that the scope should include more than the non-GAAP measures, which, as I mentioned, that's certainly something we have heard from others as well, and something that the board will need to look into further. So with that, I will turn things over to Aida, if you want to cover off just the last few proposals in the exposure draft, and then I can step back with some final words.
Can I just have one question on this management performance measures? Now, the details which are given in the management discussion and analysis, can those be cross-referenced?
Yeah.
Or these will have to be, because many companies give detailed disclosures in the management disclosure and an MD&A. So is this visible in terms of this standard?
Yeah, so it's definitely something the team is looking at. And Aida, I know that you guys were doing some research on that because it keeps coming up in the feedback. Do you want to speak a little bit more about the research?
It does keep coming up, and I have to share, we raised this as a possibility to consider with our consultative groups of users and investors, CMAC and GPF. It was last month, and we were just brainstorming in the session with them that cross-referencing could be a way to address the feedback from some that there is a duplication issue there. But it was interesting that there wasn't such a great support as I expected. I think there was lots of concerns expressed in that meeting that it will become unclear for users which parts were audited, which is MPMs, which parts aren't, because not everything in MD&A needs to be audited. The information would be lost and scattered. So there's lots of skepticism, but we are definitely going to consider this. I mean, my personal view is that there is a way perhaps to consider, and address the concerns that were expressed. So it wouldn't be free for all, cross-reference however you want, wherever you want, but we will need to consider these concerns as well. So I don't want to say it's a done deal, although some say you have to allow this. Why duplicate? But certainly, we will be discussing this with the board in redeliberation starting next year.
Yeah, and I think it's an easier situation if the disclosures are in the notes to the financial statements and MD&A just simply points to the notes. I think where the bigger challenge is if the disclosures are in MD&A and then the notes to the financial statements point to MD&A. I think that's where the question about, well, what's audited and what's not audited and what are the boundaries of the audit report start to get a little bit more troublesome for some stakeholders.
Yeah, we have jurisdictions that deal with this quite well already today, where they have an MD&A report, where they have clear boxes around things that are audited when they bring things from the financial statements without cross-referencing necessarily, but just to highlight that. But it's very clear in different jurisdictions, it's different practice. So we will need to look at that.
Okay, thank you.
Yeah, so I'm not going to spend much on the statement of cash flows. As important as it is as a topic, it is a bit of an orphan child of PFS project, I have to say, because in this project, the board made a decision quite early on is not doing comprehensive review of the statement of cash flows. And really, these are more like consequential amendments, the proposals that are there. And I think partly this is the reason why I think Vijay mentioned in the introduction that even the labels of the categories, although we use the same labels, they're actually not cohesive across the statements, because the board also decided not to pursue cohesiveness, in other words, alignment between the statements fully, although in the proposals in this project where the board has tackled specifically classification of interest and dividends in the statement of cash flows, it has pursued alignment to the extent possible so that today IAS 7 basically allows choice where these are classified, and in the ED it's proposed that this wouldn't be a choice, but classification generally follows the P&L, but in some companies, as we discussed, the finance costs are in the operating, in some there aren't, so therefore you will still get different outcome depending on your main business activity. But the point is you follow across from the P&L and you have a single location. So if you have, in some situations, you might have, finance interest in different categories in the P&L. You will still have it in a single category in the statement of cash flow because the users told us they prefer cash flows to be in a single category. So that's really the one of the proposals. And the second one is a consistent starting point for reconciliation of operating cash flows. I personally think this is quite useful and helpful proposals because currently, because we don't have required subtotals in the IAS 1 for statement of profit or loss, there couldn't have been similar requirement today. So practice is diverse. Some companies start from profit or loss, some companies start from higher above. So this was like almost a no-brainer, simple fix to everybody start from the operating profit and therefore give better transparency of what is and how operating cash flows have been calculated using in the indirect method. And that's really it. There is to the statement of cash flows. We are very well aware of concerns that there is much more work needed to this statement. And I think this is a good point for me to hand over to Nili, who might give a glimpse of how we might be doing further work on the statement of cash flows in the future.
Thanks, Aida. Let me try to take control of the slides again. So we just wanted to spend the last couple of minutes giving you a flavor for some of the other projects that the board is working on that we thought you might find interesting. And the reason that we wanted to share this right now is because the board has quite a few projects that are under consultation right now or will be coming out for consultation in the coming months. And as I mentioned before, the best time for us to give us your feedback is while the consultation document is outstanding. That's the point where the board can actually think about your feedback and it can influence the development of that final standard. So obviously after something's been issued, it becomes too late. So currently, in terms of consultations that are outstanding, we have our one on goodwill and impairment. That's a discussion paper, and the deadline for comments is the end of December. A discussion paper is earlier in the process than an exposure draft. So after the board receives those comments, it will deliberate and then most likely issue an exposure draft to get further feedback. And then as you can see on this slide, we actually have 8 more consultation documents that will be coming out in the next 6 to 8 months. Business combination under common control is for group restructurings. What do you do in the standalone financial statements when sister company A acquires something from sister company B that's under the same parent? We have a post-implementation review of a number of standards where we're trying to assess whether these standards have met the objectives that were originally intended when they were developed. Rate-regulated activities, it's trying to sort of fill a hole in IFRS standards. Disclosure initiative and management commentary I spoke about before, and then we have some narrow scope amendments on IAS 21, looking into what do you do when a currency has lack of exchangeability, as well as a narrow scope amendment on IFRS 16 related to sale leaseback transactions. And then finally, the board every 5 years does a strategic consultation to get feedback on what its priorities should be for the next 5-year period. And we call this the agenda consultation. The board is in the process of developing its agenda consultation right now, and the request for information will be coming out in March. So this is the opportunity for you to tell the board whether you think the board has the right priorities and is spending its time on the right projects. If there's something else that you think the board should be working on, this is the place to let us know so that we can fit that into the next 5 years. And with that, I will conclude our remarks by just saying thank you again. We truly appreciate the opportunity to be here, and hope we can do this again sometime in the future.
Thank you, Nili. Thank you, Aida. Thank you, Zubin. Zubin, do you have any final questions, or should we just conclude?
I think 1 minute. I think that management performance requirements, I think that is already covered, I think. So I don't think there is any outstanding question.
Thank you. First and foremost thing, let me thank Mr. MP Vijay Kumar, CA MP Vijay Kumar in absentia, and to both of you all, to Nili and Aida, for taking us right from the history and the entire process of the project and now what is in store for us. So it was really informative and helpful. And thank you, Zubin, for moderating this discussion. But here, Aida, I just want to let you know that there is a standard on auditing 720, where it is the auditor's responsibility to comment or to see whether any inconsistencies are there in any other information which is forming part of the financial statement. So if if any inconsistency with financial statements, so that's also an auditor's responsibility. So that is a standard on auditing. So I think so. Well, with this, it was a very good evening that is spent with us, and looking forward for more partnership with the board, with the IASB, with our Bombay Chartered Accountants Society, and looking forward in partnering in the technology upgradation and updating of standards. And with this, I would just request our convener Amit to propose a vote of thanks and give the concluding remarks.
Thank you, Chairman, sir. It is my absolute pleasure to propose a vote of thanks to our distinguished speakers. Friends, you would all agree that we have had an excellent session on PFS project. CA MP Vijay Kumar, a very learned speaker, gave the overview of the project and he set the tone for the webinar through his keynote address, followed by the insightful session by our two IASB team members, Ms. Aida and Ms. Nili. The learned speakers took us through the key proposals in the exposure draft and their expected benefits and how it is going to be a game changer for all the stakeholders. Their presentation made it easier for all of us to understand the nuances of the exposure draft and the thought process which has gone behind preparing this exposure draft. Both the speakers also made it thoroughly interactive by conducting polls at regular time and taking questions at each stage of their presentation. We would like to thank all the three speakers for sharing their valuable time, knowledge, experience, and insight on this path-breaking PFS project and accepting our invitation and agreeing to be with us despite their busy schedules, which also goes on to demonstrate that strong commitment for sharing and spreading of knowledge. This is just the beginning, and I'm sure in the future, we will have many more occasions for interactions with IASB team on BCAS platform, as we at BCAS are equally committed to spreading of knowledge and reiterate our commitment through conducting more such kind of presentations and programs in future. With this, I, on behalf of the Bombay Chartered Accountants Society and all the viewers, propose a very hearty and well-deserved vote of thanks and request all to carry out with loud applause. I also take this opportunity to wish everyone a very happy and safe Diwali in advance. Thank you so much for participating and making this webinar a success. Thank you.
Thank you.
Thank you.
Amit.
Thank
Thank
you.
you all.
Thank you.
Thank
And
you.
happy
Thank you.
Diwali.
Thank
Happy
you,
Diwali.
Thank you.
Bye-bye.
Thank you.
Bye.
Bye.
Same to you.
Thank you, Himanshu Bhai, for your presence. Also.
Yeah.
Thank you, Himanshu.
Himanshu, you're on mute. Yeah.
It's always a pleasure to hear the IASB stuff. You always learn something new.
We are really enriched. Thank you very much.
Thank you for having us.
Thank you.
It was our pleasure. So,
Yes, thank you all.
Thank you.
Take care. Take care.
thank you. Bye-bye.
Bye. And have a noiseless, cracker-free Diwali. That's what India is promoting.
Oh, it's not as much fun.
Yes.
Bye-bye.
Bye, everyone. Take care. Bye.
Bye.
Hello. Hello.
Please end the meeting.
अपना मीटिंग चालू करते हैं ना
जावेद गया कि है? हेलो